Hey, my name's Rajesh. I'm a direct lender based in Los Angeles, specializing in multifamily properties. And today's video topic is you do not need a bank. What do I mean by that? When buying an investment property, most people think they need to go to a bank. Investment property equals loan from bank. And this is not true. You do not need to borrow money from a bank. When you borrow money from a bank, you need tax returns. When you don't borrow money from a bank, when you go with, let's say, a DSCR loan, you do not need tax returns. Let's see here, tax returns, cross that out, and that's the difference. You still need a decent credit score. Let's say over here for a DSCR loan, and I'm talking 5+ units, you do need 700 FICO. If you're just buying a single family, if you're buying 1 to 4 unit, that might be a little bit flexible, can go as low as 680. For investment properties, here you need to go as we'll go as low as 680 with a bank loan. Let's see here. So we have income, we have credit, and now we need property, the collateral. Property. So we want to make sure that this is in good condition. Well, that's not true. I've bought some properties with bank loans that were not in good condition. This is livable condition. Livable condition per Fannie Mae and Freddie Mac's guidelines, and it needs to rents, and this is rents need to cover 1.25x the debt service. Let me see that. NOI, net operating income, needs to cover 1.25x the debt service. So let's go dig deeper into that. So let's say rents are, let's say, $20,000 a month, okay, and property taxes are $3,000 a month, and insurance is $1,000 a month, and then you've got property management at, let's say, 5%. Okay, so 10% would be 2,000. So property management, taxes, insurance, management, MGT. Okay, and then you've got the other costs like trash, common area utilities, pest control, maintenance fees, lawn and grass, landscaping. Let's say all that adds up to, I don't know, another 2,000 a month. So now we've got 20,000 minus 5,000 minus 2,000, so minus 17,000. You're at $13,000. This is your NOI. Okay, bank loan. So they're going to use this number, and they're going to divide it by the principal and interest. And the principal and interest is determined by loan amount and interest rate. And I actually want to take this back right here. Your credit score is not going to have to be 700. They're looking more, they're going to require a minimum of 700 right there. I just did a property a little while ago, a 14 unit in Washington D.C. that was that they required a minimum $7,000 or 700 FICO on there, 700 credit score. So P&I is determined by loan amount and interest rate, and loan amount is determined by down payment. So let's say that your monthly P&I is equal to $12,000 a month. 13,000 divided by 12,000 is 1.08, and then 3 to infinity, but that's below 5, so we're just going to leave it at a 1.08x. So this is a net DSCR ratio of 1.08x. That means the NOI is if you were to multiply 12,000 by 1.08, you would get 13,000. This loan would not get approved with a bank loan. But let's say with a non-bank loan. Okay, and we're still doing the same 5 to 8 unit building, and we're still doing the same numbers. So 20,000, 3,000 taxes, what was it? 1,000 for insurance, 1,000 for management, and 2,000 for OpEx. Okay. And we still end up with the same 13,000 NOI. But with the non-bank loan, what we're going to do is take this one and divide it by the PITI payments. So now let's see what happens here. We're at 12,000 a month, right? So 12,000 for the P&I plus 3,000 for tax plus 1,000 for insurance. Insurance. So that takes us 4,000 plus 12,000 is 16,000. So we're at 20,000 divided by 16,000. 20,000 divided by 16,000. We are at a 1.25 x DSCR ratio. Gross. So this same loan would get approved, assuming you had your minimum FICO of 700. Now the interest rate would be slightly higher, but you get the building. That is the cost of this product. Just like an Apple costs more than a Huawei or an other unknown Chinese brand, and I know I'm called out Huawei as it's a known Chinese brand, but there are unknown Chinese brands, and an Apple iPhone costs more than them. This product costs more than a bank loan, and that cost is interest. And so with this, you're generally going to be at SOFR, or sorry, 5-year CMT plus 2.25 to 2.5, somewhere in there. So if the 5-year CMT, whoops, let's see, CNBC ought to have it, 3.75, 3.753, 3.753, 3% plus 2.25 to 2.5. This is going to equal 3.753 plus 2.25. So you're at 6.0032, roughly 6 point, whoops, 3, what's going on here? 3.753 plus 2.5 to 6.253%. In order to get approved for this loan, your DSCR, in order to get this interest rate, your DSCR ratio has to be 1.25, 1.2 to 1.25x, generally speaking, when you go to a bank. So that means if we were to divide this by this, we would figure out the monthly payment, the max monthly payment. In that case, it would be 13,000 divided by 1.2. So we are at a P&I. With this, we are at a P&I of 10,400. So you would have to get your P&I here in order to qualify for this loan, because you're not going to be able to increase the rents before taking control. So the only thing you really have control over is the down payment. You increase the down payment, you lower the loan amount. By lowering the loan amount, you lower the monthly payment. With a non-bank loan, a DSCR loan, you can go 1.25x gross DSCR ratio, which again is just the gross rents divided by the PITI payments. In this case, you would be able to get it for as little as 25% down, but that's the same as saying as little as 25% down. What matters is with us, you only really need a gross DSCR ratio of 1.0x. So to counteract this example here, you would only need that 20,000 divided by 20,000. Yeah, so 20,000 divided by 20,000 is equal to 1. And this is P&I. This is PITI, and this is gross. So in order to get this number here, you're doing 20,000 minus 3,000 minus 1,000. So that means you're subtracting this 4,000 from here, so you need $16,000 P&I payments. So that means compare your P&I here, $16,000 here versus the 10,400 here, or even the 10,400 here versus the 16,000 here. And if in order to get from 12,000 a month to 10,400 a month, you had to increase your down payment in order to reduce loan amount, the reverse is true too. So that means you can you can reduce your down payment, increase your loan amount, and you get a bigger P&I payment. So you do not need a bank to get approved for financing when purchasing a multi-family building. All you need is to make sure that your credit score is up here and the gross rents cover the minimum DSCR ratio. and which is in our case a 1.0 on purchases. On refis, it's a completely different story. We can go as low as 0 refi. And we do have a bank similar product here where we can go 1.15x. So let's see what that looks like here. Again, this is going to increase the P&I, but you would basically take 13,000 divided by 1.15, and that would give you a P&I of 304. So that means your down payment can be even smaller than here, and that means your loan amount can be bigger, and that just means less cash out of your own pocket when purchasing the building. Here you're probably going to get the best deal. You may not cash flow, however, because you still have to cover all of this. So if your gross rents only cover PITI, you want to make sure that you get a building that does not have any of this. So if you're self-managing, if you are if they have no common area utilities or costs, then you are golden with a DSCR loan, which is why this is a very popular product in the 1 to 4 unit space, but not so much into the 5+ unit space. But we do it in the 5+ unit space because we trust people to be rational. So that's the difference between a bank loan and a DSCR loan, and why I say you do not need a bank to get approved for purchasing a multi-family building. So there are other financing options, and when we go hard money, we can go even lower. Then we are not looking at the rents, we are looking at the value of the building. So let's say you want to buy a $2 million 8-unit building. Your credit is below 700, so let's say it's, let's say 680 or even 650, right? And the building is still doing the $20,000 a month. Same building, doing $20,000 a month, but your credit score does not meet this one nor this one, so they're both off the table for you. Well, now you can go private money or hard money, and you would have to put a fixed 35% down. 35, some might even require 40% down. But that's because of your lower score. You got to pay more because of other compensating factors. The more loose a product is in its credit guidelines, the bigger the down payment. So here we're looking at minimum 25% down on a DSCR loan for a 5 to 8 unit. We're also looking for a 25% down. This one is typically, although this is the minimum, in order to hit these numbers here, or even this number, you're going to find that you're going to be putting between 30 to 40% down anyway. And you get the benefit of one of these interest rates as of today. With a DSCR loan, you're going to be putting typically between 25% to 30% down, although 35% is fairly common too. With this is the minimum. And at this point, we don't really care if it cash flows or not, or whether the rents cover the mortgage payments. All we care about is that you are able to afford the interest only payments for 12 to 18 months, at which point you would either sell the building or you would refinance it and pay us back out. that's pretty much how this one would work. So you would take these 12 to 18 months to improve your credit score, and then you would be able to go back to a bank loan, because again, you've already put 30 to 35 to 40% down, whereas over here on a bank loan, 30 to 40% down is pretty common. So at this point, the DSCR ratios are already working in your favor, but you don't have to pay principal. You would be doing interest only, and you would be using that time to get your credit score up to above 700. Everything else stays the same. Oh, right, the interest rates on these. You're looking at generally 8.99 on the generous side. Well, no, 8.99 is reserved if you have a good credit score, which is 700 plus. And if you had that, you would not need to do this loan. You would just do this or this. We're looking at a 9.99% interest rate, although I have seen some as low as 8.99%. That's more bridge loans, but we're generally speaking 8.99% to 11.99%. And I've seen some rates go as high as 12.5%. This is what I'm seeing as typical or common. What's uncommon is I've seen some rates as high as 14.99, but that's few and far between. But again, you're only paying the 14.99% on 60% of this amount. So let's get some numbers here. 2 million times 0.6. Now you had to bring in $800,000 just to get the loan amount down to 1.2, and now you're at a 14.99% times 14.99%, which is 179,880. 179,880. Divide that by 12, and you are looking at monthly payments of $14,990. Interest only per month, interest only. And then after that 12 to 18 month term is up, you would do a rate and term refi at a bank, hopefully with this much better after you have improved your credit score up to a 700. So again, you do not need banks to get money, and if you look at this, the 14,990, it's still less than this, the DSCR loan, which was at 16,000 to get the 1.25x ratio. And at a 1.25x ratio, you're generally looking at a 7.5% interest rate to, well, no, that's not true. You're looking at an 8.125% interest rate in today's environment. So that would allow for a smaller down payment or a bigger loan amount. You could buy down points. Now you can buy down anywhere from 1 to 5 points and put that cost on the seller. But then we're looking at maybe anywhere from a 6.5, well, I want to say 6.0, depending on the prepayment penalty. And I know that if you go with a 5-year prepay penalty and you buy down about 5 to 6 points, you're looking at a 5.75 to a 5.875% interest rate right now. But yeah, this is worst case scenario. If we're looking at 9.99%, let's see if my calculations hold out, times 9.99%, which is 119,880. So 119880, divide that by 12, and we are looking at, and my personal theory did hold out. So you can sort of multiply this by 1,000 and you will get your monthly payment. So if you're able to get a 9.990, your monthly payment's less than 10 grand a month. If you're able to get a 12.50, your monthly payment is 12,500 a month. And if you get 11.99%, your monthly payment is $11,990 a month. And this is all IO. So again, there are ways to get loans and financing for your purchases depending on what you have going for you. If you have good credit, you can get it with a fairly low, and the collateral is right. So if the collateral is good, the credit is good, and the income is good, you get a low percentage rate, a low interest rate in the low 6s to high 5s. If and you will need income tax returns on a bank loan. On a DSCR loan, you just need the gross rents and your credit score to be good enough. And gross rents would be part of collateral right here. With a hard money or private money loan, hard money, we don't care about the tax returns, we don't care about the credit score, we don't even really care about the rents. We care about the value of the building. Value of building. And here you are looking at low 5s or high 5s to let's say 8s, low 8s. And here we are looking from maybe 10%, high 9s to maybe 14s. All we care about is the value of the building. So and we're going to give it to you at a huge discount. That means you have to come in with a lot of cash to close, anywhere from 60 to 65% LTV, or 35 to 40% down. So if you don't have good credit, you don't have tax returns or a stable job, but you have a ton of cash to put down, you can buy this building without needing a bank to do so. And that's pretty much it. That's the episode.